It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome to the program. It's so exciting. There's not a lot to reference for what's going on this weekend. I've asked Mark, but he has come up short. I mean, it sort of feels like World Cup, Wimbledon, U.S. Open golf, all those things behind us. I don't know, second half of the baseball season. What else you got, Mark? Oh, my God. NFL training camp? I can't. It's too soon. Mark, we didn't even have our John Tavares Islander conversation when it happened. So I should just point out to everybody that Islander Nation was in shock, but now is in full-blown rage. So there you go. If you're not a hockey fan, you don't care about this. But a lot of our fans are hockey fans. So I put it to you that way. Oh, gosh. All right. If you have a financial question, we've got lots of stuff for you. First things first, you've got to send an email. Ask Jill at Ask Jill at JillOnMoney.com. I was just giving you the podcast one. Ask Jill at JillOnMoney.com. If you would like, you can actually go to the website. There's a whole bunch of resources there. There's fun stuff. Oh, Mark, I found a new place I have some more resources to add. What are we going to do about the resourcing? It's getting too big. Can you make the font smaller, or what am I going to do? All right, I got a bunch of resources for you. Anyway, I'll send those over to you because I love finding this. And some of you are sending us that information. So if you come across a cool website that's helpful, send along. We'll just add it to our resource page. We're crowdsourcing really great resources. But first and foremost, let's go take a call. We have got Andrew, who is on the line from Kentucky, which Mark says is the bluegrass state. I didn't know that on my own. I mean, I've heard of it, but I got to be honest with you, Andrew. I didn't know that. So thank you for calling from the bluegrass state. Are you calling from Louisville? Did I say it right?
Well, I am calling from Louisville, but you didn't say it right.
Say it again. Okay. Just say it again so I can get it.
Okay. It's pretty easy, really. You just say Louisville.
Louisville.
Yeah, just
Louisville.
Like that. You just say it real quick, real
Louisville.
smooth. You don't spend a lot of time on it.
Yeah, because if you hear someone from New York, we will say, like, it's Louisville. No, wrong.
Yeah, wrong.
Andrew, tell us how we can right your wrong. Tell us what we can do for you.
Okay, so I'm in that strange place of I just retired, and I never thought I'd be here, one of those people, but I'm here now. And I had, mutual funds and investors, and, I work for small companies, but I invested in everything. So I'm here now, and I'm looking at, what I have, and I don't want to lose a penny, of course, because I don't want to go back to work. Mm-hmm. So I'm wanting to know, what is a comfortable position between bonds and mutual funds, a percentage?
Okay. You mean stock mutual funds, is that right? Okay.
Yes.
So how old are you?
How do you think I am?
You sound like you sound like early retirement. You must be 47 with millions of dollars in the bank.
I'm 67.
All right.
And, I don't have millions, but I'm comfortable. And my house is covered, and my cars are covered, my insurance is covered. I'm not worried about that.
What's your income? Tell me about what's coming in.
My income now?
Yep, like Social Security.
Yeah. You want to know the dollar amount?
Yep, sure do.
Okay, so I'm $2,200 a month, and Medicare is taken out of that. So I'm $22 after Medicare is taken out.
Okay, so that's net.
Okay.
And
so my wife is working.
Yeah, God bless her. Didn't you do it the right way?
Yeah, well, I'm just getting started.
Mm-hmm.
So she makes a nice income, and she's drawn off of me.
So she's getting $1,100 from you?
Yep.
Okay.
And her Medicare is coming out of that too. So it's actually about 8 or 9.
Okay. So you got about $3,000 a month from Social Security total, right?
Yep.
Okay. How much is she making right now working?
She makes about $90,000 to $100,000.
Nice.
Yep.
Is she going to keep working? Is she about?
That's the debate right now. We didn't want to both retire at the same time because we'd probably kill each other. And so the advisor said, why don't you retire, if you're going to do that, and let her kind of keep going for a little bit, and you guys kind of ease into it.
Nice.
So, that's what I'm doing.
Okay, so let me ask you a question.
Yep.
How much money is in your retirement savings?
My funding is right at $400,000.
Okay. And how much does she have saved in her retirement?
She has about $150,000.
Okay. And do you receive a pension?
I don't. And so about 7 years ago, I got really concerned about that. I always worked for small family companies. I worked for 3 different ones in my career.
Okay.
And they didn't have pensions. All I had was a 401k and whatever I could save, which I couldn't save anything because I had 2 kids that wanted to do everything in the world. Anyway, that's another story. But I didn't have a pension, so I started looking at annuities. And I listened to one person like yourself, that said annuity would be good. And I listened to some person and said, do not ever buy an annuity. Mm-hmm. So I was caught in between, but I didn't have a pension. So I just jumped in and bought an annuity about 7 or 8 years ago. And now, if I can make it to December 2020, I'll have be able to draw $368,000 is what it is.
Hold on a second. $368,000 was put in. You put a lump sum in, and you can, if it were to last until 2020, you'll have access to $368,000, which you can either annuitize, take out in little dribbles, or roll over and do whatever you need to do with. Is that correct?
That's exactly right. And I could draw on it now.
Yes.
But if I wait until 2020, it'll be valued at $368,000, I believe it is.
And is this a fixed annuity? In other words,
yes.
It's
guaranteed.
Fixed. Guaranteed fixed.
Yes, it's through. I think it's through like John Hancock or something like that.
Okay. Got it. I'm writing down notes very quickly here.
Good.
So good. And the money that went into that annuity, was that money that you had in cash, or did that come from another retirement plan?
That was from my 401k. When I left the company, I put it in there.
Okay. So you've got $368,000 in there, and then when you said you had $400,000, was that part? Did that include the annuity, or in addition to the annuity?
No, it did not include the annuity.
So that's in addition to.
Yeah, my total account value is like $675,000 with both of them added together.
Bang! Love that. Now. Okay, and your wife is how old?
She's 66.
Okay. How much longer do you think she's really going to work?
Well, she says, what if I go to 4 days a week? They'll let me go to 4 days a week. So I know she's wanting to pull out because, we want to we want to start enjoying our life.
All right, I'm going to figure out how you can start enjoying your life. Here's what we're going to do. We're going to go to a break very quickly. We're going to come right back to you. Then we're going to get back to your question, which is, what's the right allocation for you going forward? So when we return, more with Andrew from Louisville. I hope I said it right that time. And if you've got a financial question, we'd like to hear from you. Our email address, askjill@jillonmoney.com. We'll be right back.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
You're back with Jill on Money, and if you've got a financial question, we'd love to hear from you. It's so easy to get in touch with us. All you have to do is send us an email. AskJill@JillOnMoney.com, and we'll get you on the air. Before we went to the break, we were talking to Andrew, who is recently retired. Woohoo! He's 67. He's got some income already. He's got about $3,000 a month coming in from Social Security, and his wife is still working, which is fantastic. He's got about $650,000 saved in retirement. Some of that's in an annuity. Some of it is not. And his wife's got a bunch of money that's saved in retirement. So all of this is great news, Andrew. What is your desired monthly income? In other words, if you look forward, and you said your wife was not working right now. You've got $3,000 coming in. How much more do you guys need to live a good, fun retirement?
I've run this so many times. I add up all the monthly bills and put in little things for extras and everything. And I think that I need between $8,000 a month, $9,000 a month, something like that, to feel really comfortable.
Okay, so $8,000 or $9,000 a month.
I think so.
And so you've got $3,000, and then when your wife retires, will she be able to then claim her own Social Security for a higher amount? Well, in other words, will your
she's letting hers roll.
Okay.
8%,
So tell me what her Social Security maxes out at, so we can just back out and see how much money we're generating from this portfolio of yours.
I think it's going to max out at like $2,400 or $2,500 a month.
Okay. So, I mean, you'll have half of your retirement need from Social Security. Fair enough?
Yeah, I think so.
Okay.
Yeah.
So now we've got to get about $4,500 out of your portfolio, which, forgetting about the annuity, what it will be worth, it looks like you've got about $800,000 right now that's socked away. Do you have any non-retirement assets that are available to you?
I don't think so. I think I pretty much coughed up everything.
Mm-hmm.
That's it. I can sell my guitars.
No, I would never, ever, ever tell you to do that.
Okay.
It's tight to get so if I wanted to get $4,500, and look at your retirement, I would say, first of all, of course, your wife can go to 4 days a week, and if she weren't making 90 or 100, and she was making more like 60, and she was able to do that for a few more years, that would obviously help. I would love it if your retirement portfolio were, let's call it 1.2-ish. Okay?
Yeah.
And the reason is that would allow you guys to start withdrawing from the portfolio to supplement Social Security in a way that would give you enough cushion if markets were up, markets were down, with a little inflation factored in. Look, the annuity is fine. You could wait till 2020 to annuitize it, but what's really more important is if we have her drop out of the workforce right this second, then we do two things. One is we have to start eating into the total retirement assets sooner, and we don't have her putting away any money. So the combination of that becomes kind of difficult. So I would say this. Let's say you want to really get that $8,000 or $9,000 a month. Then I would say she's got to work a little bit longer, and we got to try to build you up to, $1 million at least, 1.2. If you say to me, I want her done sooner, then you've got to set your sights a little lower. You have to say, okay, not $8,000 or $9,000 a month. We'll be fine. We'll live on $6,000 a month, and that's what we'll do. So I think those are your big picture items. Now, in terms of your original question, which is essentially, how should I allocate my portfolio? I think you kind of want to have a balanced portfolio. You want some stocks, some bonds. Do you own individual bonds? Because I noticed that you asked about bonds and stock mutual funds. So was there a difference, or are they all in mutual funds?
No, they're all in mutual funds, but I have, bond accounts like a TIPS,
okay,
a TIPS bond and a JP Morgan bond and I'm about 30% bonds and 70%, stock mutual funds right now.
Yeah, but you do have the annuity, and the annuity's fixed, right? So that's
it is.
So that consider that that is 100% bonds. So if you push that together with your other allocation, you probably are fine. You really are.
Okay.
Why do you have JP Morgan funds? Do you work with a JP Morgan sales guy?
I do.
Nah. How much does he charge you?
1.2.
Stop it. Do you need him?
I think I know what I'm doing without him, really, but I just needed someone to make sure I didn't screw this up, because I'm 67. It's not my business. I'm way away from a financial advisor, believe me.
Yeah, I mean, look, I think first of all, one good way to save some money would be to go from a JP Morgan 1.2% advisor to a Andrew does it himself or uses an online advisor like a Betterment, a Wealthfront, Vanguard, where you're going to pay instead of 1.2, you'll pay 0.25 or 0.3, and that extra 1% falls to your bottom line. So that may be one thing to think about. I'm not convinced your wife should be retiring anytime soon. But again, if she does really want to, then what I would say is you got to spend less money, especially early on. So
okay, I'll just tell her that.
Yeah, great. You're going to say, hey, this girl told me you have to keep working, which is terrible. Now you've made me the bad guy. What about you? Can you do a little part-time gig or what?
I can. The object was I didn't want to.
You're young and you sound young. I just told you sound like you're 47. Come on. Can't you do something? Just make a few bucks, not a lot. Like, couldn't you make $1,000 a month doing something?
Yeah, probably could. And I've had people say, you could be doing this. There's a lot of opportunities for you to do this. But, I walk around Walmart or Lowe's and I think, I don't want to do this.
Well, wait, what did you do for a living?
I was a national sales manager.
Okay, so obviously you could basically do anything because you're a salesperson. So that's you're one of those. I don't know. Find something. What's your hobby? What are you doing with your fun time?
Play music.
Music? Go work in a music store. Go make some money. Go teach some guitar. Go do something cool. Come up here and teach me and Mark how to play guitar.
My son lives in Sugar Hill, so I come up there and visit him. In Hamilton Heights, so in New York. So maybe I could do it there.
All right, that sounds like a good game plan. Yeah. All right, Andrew, when you come to New York, we'll teach you how to talk and not sound like you're from Louisville. All right?
Okay, well, look, thanks for your help and advice there. And I'll talk to her over dinner tonight.
Oh, great. Don't call us. We'll call you. I'll send the bottle of booze just to make it a little bit easier. Thank you so much for calling.
Okay. All right,
Take care. Oh, boy. What do you think, Mark? I think you retired a little early. Unfortunately, national sales manager. I could have used a couple more years. Imagine how great this plan would have worked. Just not that he can go back in time. Don't send him this part, Mark. Just imagine, had he worked until he was 70, he'd get 3 more years of putting money into his retirement. And then he doesn't claim Social Security till he's 70. He maxes out that noise. She waits till she's 7. I mean, it all works so much better. The answer, of course, always becomes work longer, which is why you guys can't stand it when I give that advice. I'm sorry. It's not that I'm like, oh, you must work. It's just that to live the retirement life that you want to live, it can be very helpful to work just a few years longer. If you love what you do, it's great. Like Mark, he's going to work till he's 88. You don't have to work that long because I'm so old. As soon as I leave, you'll just have to find another one. You'll probably find some young financial person and just dump me. After I do all this hard work shaping and forming you, I'll be like the dumped first wife. Okay, you're listening to Jill on Money. If you would like to get in touch with us, ask Jill at JillOnMoney.com. And don't forget to go to the website, JillOnMoney.com. Sign up for our free weekly newsletter. We'll be right back.
Have a finance question? There are many ways to reach the show. You can call anytime at 855-411-JILL, send an email to askjill at JillOnMoney.com, or tweet a question on Twitter using the handle at JillOnMoney. Just use the hashtag AskJill.
You're back with Jill on Money. If you would like to reach us, we would love to hear from you. The easiest way to do so is to send us an email. Ask Jill at JillOnMoney.com. Very easy to do. Okay? So great. All right, let me get to a question here from, he wants to be anonymous. I'm going to call him Randy. Just because. I'm 62 years old. I'm married. My spouse is 63. Neither of us is taking early Social Security. We plan to wait until 69 or 70 to apply. I am an attorney and I'm still working. And I plan to work until at least age 67 unless health issues get in the way. Both of us are healthy. Our joint Social Security monthly checks should be around $5,500 if we wait. My income is currently $400,000 per year. My wife has an antique business, which is somewhat of a hobby. It nets $20,000 a year. Hey, that's a nice hobby. It's a hobby that nets, which is good. We have about $400,000 in a non-retirement account, $2.1 in retirement funds. My wife has farmland worth $500,000. We have a house with about $475,000 of equity, a lake place where we plan to retire. We gift about $20,000 a year to our 2 kids. We'll probably sell our house in about 5 years. The non-retirement funds are mostly in equities and bonds, 60-40 split. Half of the retirement funds are in 2 REITs that are paying out about 5.5% dividend with increases in unit prices annually. The other half is in a self-directed 401k with 60-40 split between equities and bonds. Should we be doing anything different to prepare for retirement? We'll probably need about $150,000 a year because of travel and grandkids. So let's just do a back of the envelope calculation here. So they're going to have about $60,000 in Social Security. So we need $90,000. He's got 2.1, 2.5. I don't know about that farmland. Who knows if you think that farmland I can count? Is she going to sell it? I don't know. Looks to me like we're going to get, let's just see something. Maybe it's about $3 million. So, you know the back of the envelope calculation that I'm about to do. I'm about to say $3 million times 3.5% withdrawal rate. That'll get them there. I think they're close. So I think you'll be okay. So 3.5% withdrawal, meaning you take out 3.5% annually. I would say that you're close based on what your needs are. You'd have to sell the farmland and, or make sure that equity gets saved. A couple of things that come to mind for me as I read this. Number one is, why are you gifting the kids right now? I think you should stop doing that. I think you can wait. I mean, if you've done a bunch of gifting, fine. But, you don't have that much money. You don't have so much. You want to spend a lot of money in terms of required retirement income. And I think it could be dangerous for you to be gifting every single year. You don't have that much money. So I would stop doing that for right now. I also am feeling like the REITs, I get the dividend payment, but, REITs can actually drop in value. And so, you might love it. Wow, my yield is 10%, but that means the value of the REIT has gone down. So considering that they're in retirement funds, I might start to cycle out of those as we come into retirement, and maybe even sooner rather than later. And I think that what I would flip it around, where the non-retirement funds, I would have 40% in stocks and 60%. I'm sorry. Yes, 40% in stocks and 60% in bonds. I would flip the allocation because you're likely to tap that money before you collect Social Security. So we want to lock it down a little bit. So I think that having a 60-40 split in retirement funds, fine. I mean, I'm kind of a 50-50, very wimpy gal. But I think I'd flip it on the non-retirement funds. So that's about it. So I thank you for writing. I hope that makes sense to you. And if you are considering retirement, one of the things to really consider here is, how can I make sure that I make my money last? And one of the things you can do is you can delay Social Security, which he's doing, but also, to be very clear, gifting can be a little bit dangerous. I ran into this recently with somebody who was gifting quite a bit. And after running some retirement numbers very quickly, I said to her, I think you're gifting too much. And I think she was appalled by this. Of course, as the non-parent, I'm always happy to be the one who rains on the parade, right? But gifting is a wonderful thing, but you really have to be clear, like, am I gifting too much? I mean, you're in your 60s, you're going to have a lengthy retirement. I think it's incredibly important that you make sure that you can afford to do that gifting. And also, I wouldn't also get locked into this idea that the kids are going to get it every single year, because there may be some years that you're not going to be able to do it. So I think that you should make sure that your kids understand that they may not get this money every year. It could happen, but it may not. So up front, make sure you run some numbers. I think you can do the 150 a year. It'll be hard in the beginning years, certainly, to generate that 150. And don't forget that the 150 that from the money that you get from Social Security will be taxed in the beginning years when you're pulling money from a non-retirement account. You get that. But when you pull it out of the retirement account, you'll have to actually pay tax on that. So all that being said, I think you're in good shape, but you're not in like fantastic shape because of the 150 number. If you were willing to be at, say, $100,000 a year, then I'd say you're in fantastic shape. But this is what you've set up for yourselves, and obviously for you guys, it's important. I think it is very clear that when you're in the early stages of planning for your retirement, you have to be very careful not to spend too much money in those early years. We need to preserve the body, the corpus of the estate. We need to preserve that because that's the little engine that can. That's what's going to keep generating the money for you. So if all of a sudden, you had $2.5 or $3 million and you spend too much money early on, and all of a sudden you're at $2 million, that's going to change your calculations. And I'd hate to be the person who says to you, oh, gee, I know you're used to spending $150,000 a year, but now that you're 79, you can only spend $100,000 a year. I'd rather have to know what that number is in advance. Okay, you are listening to Jill on Money. If you've got a financial question, we want to hear from you. Ask Jill at JillOnMoney.com. Hop onto the website, JillOnMoney.com. You can check out our podcast, Better Off, where you can see what's going on in the podcast world. Stay tuned. We'll be right back.
The cure to your financial problems could be just a phone call away. 855-411-JILL is the number to dial. Back to Jill on Money with Jill Schlesinger.
You are back. Mark and I are pumped up and ready to rock and roll. We have been from the beginning, but this is kind of the part of the hour where we might want a little jolt. I'm trying to reduce my coffee intake. Oh, Mark, I almost texted you yesterday. Guess what's opening up in my neighborhood? Blue Bottle. Exactly. Mark is the coffee aficionado of my life. He's not only a great producer, but he is the man who turned me on to pour over coffee and got me hooked into a habit that is basically causing my eyes to jitter, my hands to shake. He's like, you don't have to do it every day. You don't have to drink 4 or 5 cups a day, but it's so good. Anyway, Blue Bottle opening up. And what's the best one? The Columbia? Is that you're all right? You don't do a flavor coffee, do you? No. Sometimes I like a little flavor coffee. I'll admit it. That's not a very coffee aficionada kind of thing. But all right. If you've got a financial question or you want to tell me your favorite Blue Bottle coffee, just send us an email. Ask Jill at JillOnMoney.com. You can follow us on Twitter also, by the way, at Jill on Money. I guess you can go to my Facebook page, and it's sort of some combo between my real life and my managed personal life. Managed, remember. You're not going to find anything that interesting on there. But in terms of like my detail of my personal life. So that's why I kind of combined the two. It's probably not the smartest thing in the world, but there, I've done it. So go to our Facebook page. I believe it's called Jill Schlesinger. It's not called Jill on Money, is it? I don't think so. I think it's just my name. And Mark has no social footprint anymore. He doesn't. He and I have merged our social lives. That's what's happened. Okay. Go to JillOnMoney.com. You can listen to past shows. You can also read columns that I write. Mark, you're going to have to start writing columns under your own byline. That's what we're going to need to do. You can watch videos and television appearances. You can sign up for our free weekly newsletter. All of that at JillOnMoney.com. Okay, so here is an email from Sarah. And she says, my husband and I have retirement money that is already invested in an actively managed and successful account with an advisor. I'm always suspect of that, by the way, but I'm going to presume that that is just exactly what you say it is. Anyway, Sarah moves some money into a Charles Schwab Roth IRA account. The money is just sitting there. she has not yet allocated it to specific funds. I don't know how much she has or whatever, but she says, I have identified 2 funds, potentially 1 ETF, that I'm very interested in. Do I just plug them in? I've been holding off out of ... some type of fear. Anyway, here are the funds. JP Morgan Growth Advantage C. She says, with Schwab, there's no load and no fee. Let's just back off for a second. That is impossible. There is no load, meaning there's no upfront load, but there is a fee. It's called an internal management fee. You are buying a C share, which usually means a level load share. So when I look up JP Morgan Growth Advantage Fund C, you're absolutely right. There's no upfront fee. Guess what the expenses are? The expense ratio is 1.64%. 1.64% annually. Therefore, that does not make sense to me at all. Do not do that. Absolutely not. But let's see what else you've identified. I also like the Schwab Total Stock Market Index. Yes, that I like. That's the one. Use that. Cheap. We're talking about, a few basis points. And then there's an ETF iShare that is the Low Carbon Exchange Traded Fund. So what's the point of the low carbon ETF? You want to do a little green investing of some sort? You want to have some, semblance of trying to make sure that you don't have anything yucky in your portfolio that makes you uptight? You sort of negate that by having the index, because you're going to have all sorts of high carbon ETFs. High carbon stocks that are going to be in there. I don't know. I have no opinion on the low carbon ETF. For a stock market position, Schwab Total Stock Market Index makes a ton of sense. I would stick to these indexes. That's the cheapest. And you're going to find, I think, that you're going to be a lot happier with those. Okay? Sarah, if you want to write back and tell me a little bit more about your financial situation, I'm certainly happy to hear you out, and maybe we can make a good decision together. So I will encourage you to send me some more info. And I'm sort of interested in what's going on with the managed fund that you're so happy with, because I want to hear what's making you so happy about it. We like happy people, generally, even though we ourselves are not so happy. But I like when you're happy, and I like a success story. So let's hear from your successes, Sarah. Give us a shout. Anyone out there listening, if you've got fun success stories that we should be talking about on the air, just send an email. Ask Jill at JillOnMoney.com. Got that? Ask Jill at JillOnMoney.com. And you can always go to our website, JillOnMoney.com. You can listen to past shows. You can check out any part of this show that you've missed. You may also want to subscribe to our podcast, Better Off. You can get it on Apple, Radio.com, Stitcher, Google Play, anywhere else you find your favorite podcasts. And we have some of the same guests, but we use different content on the podcast versus the radio show. Sometimes we overlap, but we try to make it a little different for you. All right, it's Jill on Money. Give us a shout. We'd love to hear from you, and we'll be right back. You're back with Jill on Money. If you've got a financial question, we'd love to hear from you. Very easy to do. In fact, just go to JillOnMoney.com and you'll see a contact us button. How about that? Do it right from there. Very easy. Very, very easy. Okay, Tina, let's see, says, I don't have any debt. I live with my boyfriend of 18 years, no kids. I've got about $500,000 in my 401k. I've got a Vanguard account with about $100,000 in it, a savings account with $75,000, maybe another $10,000 coming. I'd like to put it in something that will grow, but not in something I cannot touch. I've been a good saver. I want to enjoy my money. I'm 56 years old. A money market, maybe a Roth. Do you like Roths? I love Roths. look, I think that to say is $500,000 in retirement at age 56 a good number depends on how much you spend. But if you're a good saver, then you've got 500 in retirement, 100 in savings, and actually 100 more like it'll end up being 185 in liquid. It would be great if you could put some of the money in a Roth. You can get it out. You're over the age of 50, but if you can make that Roth contribution, that would be great. The thing is, if you want something that's going to grow, then that means you would have to take risk. Are you comfortable with risk? If you are, and you've got a Vanguard account already with $100,000 in it, then add to that account and use low-cost index funds. And maybe if you just like having a nice hefty savings account, just make sure you get a higher yielding savings account. You can do that with internet-based banks or sometimes with higher yielding money markets, but you might want to look around. I think that if you have money that is available, you want to put it to work, and putting it to work means risk. And if you can manage the risk, that's just fine. If you can't, then pick some low risk options. Try it that way. All right. Thanks for writing. And hey, thanks for listening. That's 1 hour down. Another one to go. It's Jill on Money. If you've got a question, shoot us an email. Ask Jill at jillonmoney.com. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome back. It's hour number 2 of Jill on Money. Hey, Mark, you know what I think I want to get? I think I want to get a physical stopwatch. Is that old school or what? I mean, I have my phone, but I don't want to have my phone on. I feel very distracted. I don't know about you guys. I'm going to try. You ready for this? I'm going to try to disconnect later in the summer. When I'm on my 2-week vacation, I'm going to really try not to look at email. You think that's dangerous for me, Mark? Why? You think I'll go crazy or I'll just end up with 1,000 emails? I don't know if he says it's going to freak me out. Anyway, hey, today we have a returning guest. His name is Justin Nielsen. He's Market Research Director at Investors Business Daily at IBD. You can find their website at investors.com. And we're talking about some kind of big picture stuff. So let's talk big picture with Justin Nielsen from IBD. So we have brought you back today because it's a little bit more than mid-year. Kind of wanted to get your take on how the macroeconomic cycle impacts investors. Now, you guys at Investors Business Daily do a lot of trading. And last time you were on the show, we were talking about, who is the type of person who should manage his or her own money. And I think that there are a lot of different ways to think about managing your money. And I know that we often will get questions about big picture, like what's going on. And so, we're talking to you right after President Trump announced that the administration is coming up with another $200 billion worth of Chinese imports on which they'd levy a tariff of 10%. And I think this prompted a lot of people to say, oh, my God, we're now really in a trade war. And so let me start with you with that moment, which is if you're an investor and you're worried about this trade conflict escalating, what do you think you should do?
Here, it depends on your time frame.
Right.
If you've got a long-term time frame, this is a blip. It's meaningless. You're not going to be doing anything. You just kind of stick to the course and go with your long-term trading plan. If you are a short-term trader, then everything about the trade wars adds uncertainty. In fact, it was so funny because there was that first round of tariffs, the 25% tariff. And there was the buildup, there's the will he or won't he, the sides being drawn up, who was it for, who was against. And then when the actual event happened, the market was up the next day. It was kind of like the uncertainty had kind of been taken away. Now it was a reality, and it was kind of like, So I think a lot of times with this stuff, the uncertainty does add for extra movement in the market. If you're going to be a short-term trader, yes, you can play that. But if you're a long-term trader, a lot of the stuff it's just a blip on the radar. It's not even a blip sometimes.
And if you were a short-term investor, and let's just say you've got a play money account, what is the view from Investors Business Daily around trying to pick the winners and losers of these tariff conflicts? Are you guys doing that?
You can make all sorts of very smart analysis and back everything up that you've said with all sorts of data. But when it comes down to it, a lot of times we just look at what the stocks are doing.
Mm-hmm.
The stocks, really kind of, when you start seeing who's leading and who's lagging, it becomes very clear what the market is deciding is going to happen. And so there's a lot of that mass psychology, and you can try and second guess it and everything like that. But when it comes down to it, a lot of this stuff is decided by the market as a whole, and you can either be on the right side of that or the wrong side of that. And a lot of times, at least on the short term, this is where charts become very critical. Looking at charts, looking at patterns, because these patterns just repeat themselves over and over and over again. But things change very fluidly in the market, and everyone kind of has all the same information. So it's not until new information comes out that shifts everything. You really kind of figure out what actually happened. I mean, hindsight is the easiest way to do the analysis, because when you're talking hindsight, it's like, oh, of course that's what was going to happen when all of these factors were in place.
Right.
But,
and meanwhile, your emotions are telling you 500 different things, like, you're scared and you're nervous or you're greedy, or whatever all those things are, right?
Exactly. So a lot of times it really comes down to the chart and risk management. You can make a lot of mistakes as long as you're keeping your losses small, then you will do fine. One of the stats that we have that is just, it's mind-boggling, but when you look at the leading stocks, the stocks that everyone's talking about, the ones that everyone wants to own, when they top, they tend to go down on average 72%. That's a huge number. And in order to get back from a 72% correction, you have to make almost 300% on your next trade, get back to even, right? So the big thing is just to be not sitting through things that are going through 72% corrections. And so by watching the market, looking at the charts, you kind of avoid those big downturns. You cut your losses, you have risk management rules, and your analysis can be wrong. Things can change, things can be different, and you won't get too hurt. That's the biggest thing.
Have you been surprised about the resilience of the stock market, whatever the index is you want to choose, in light of the trade announcements that have occurred in the first 6.5 months of the year?
I've been shocked with the resilience for years now. I mean, forget the trade wars. Here again, this is where I really had to kind of put my personal opinions to the side. Just looking at what the market was doing, we had this huge move. I mean, really, if you think about it, from 2009, we've had the NASDAQ composite has had maybe a couple times where it's gone down 20% off its high. And even then, it happens for about 5 minutes. It happened in 2011 when there were global recession fears. I think maybe there was a little mini flash crash in 2015, August 2015, where it might have happened. I thought that we were, due for a more serious correction for a long time. And I was completely wrong. So what am I going to do? Am I going to just, plant my flag and say, no, I'm right, and I'm going to wait for the market to agree with me? Or I'm going to look and see what the market is actually doing and adjust what I'm doing based on what the market is doing in reality. So same thing here with the trade fears. My opinion is not nearly as important as what the market does in reaction. And right now, it's certainly not giving me the feeling of, oh, let's be very aggressive because of that uncertainty. And, we've had uncertainty for the entire year. 2018, we're kind of at that halftime report right now. 2018 is a very different year than 2017. Almost no volatility. The S&P 500 barely corrected I think 3.4% was the biggest correction.
Yes, 2017 had low volatility and I think did not have more than you're right, I think not more than a 4% move in either direction.
And it was a pretty big year. It was up, the S&P 500 was up 20%. So Usually, and again, this is just going back historically, usually when you have a strong year like that and the volatility kind of dries up like that, usually your next year, it might be positive, but it's not as strong. Things tend to kind of have a little bit of mean reversion. You have a strong year, it's not always followed by, another strong year. When that starts happening, then you get kind of overblown and you get into the kind of that bubble mentality that we saw like in the 1990s or even at the very end of 2007. And that's just not where we're at right now.
We'll get back to our interview with Justin Nielsen in a moment. During the break, why don't you go to our website, JillOnMoney.com? Why don't you sign up for our free weekly newsletter? And if you want to go play a little bit during the break, go check out Investors.com. That's where Justin's from. Investors.com. All right, Jill on Money. We will return in just a moment.
If you've missed any part of the show or want to check out a past show, go to JillOnMoney.com for more great personal finance content.
Welcome back. And if you have been just kind of scratching your head about how do the recent actions, trade actions, recent sort of mini moves in the market or big moves, how do they fall in terms of what's really important over time? They fall like, oh my God, this is unique, or it's kind of just what we expect. Well, I got a good expert for you. Justin Nielsen is back on the show. He's our resident anthropologist turned financial investor guy. He's from Investors Business Daily. The website is investors.com. He's the market research director there. And what's kind of cool is when you do research over the long time, super long time, there are very interesting cycles that become not predictable, but there are certainly patterns. And in this segment with Justin, we're talking about the cycles of markets and where we are right now. I want to just talk about that long term for a second, because you guys at Investors Business Daily, go to investors.com if you want to check it out. You have done a lot of long-term analysis. So you've got a bunch of data. Talk about how long these cycles can run, meaning that, we know that the bull market, as you said, it started in March of 2009. And we know that the expansion officially, I'm putting that in quotes, started in June of 2009, even though the employment market didn't really bottom out till 2010. But if we think about that, we're in the 10th year of this recovery, the second longest on record. We're really have seen enormous gains in the stock market. It's a long time. Is that normal? I mean, these big, you look at the universe in a much longer time horizon. I had heard of something called the bond super cycle. That would be like these multi-decade period where generally interest rates are rising or falling. Are there also super cycles in stocks?
Absolutely. And here again, all you have to do is if you're looking at a chart, a lot of people might look at daily charts or weekly charts on a daily basis to kind of see what's happening in the stock market. But if you kind of step back and look at monthly charts or even yearly charts, it's amazing how the picture changes. What you see are these kind of what we call super cycles, where you'll have a prolonged uptrend of maybe 15 years, even up to 20 years sometimes. 1982 to 2000 was basically one long super cycle. Sure, you had corrections in between there, but if you look at a yearly chart, it looks like it's just basically going up. Of course, nothing goes up forever, and so you have these areas that are followed by kind of sideways action where it consolidates and it takes a long time for it to make a new high. And that could be 10, 15 years. Let's just look back recently. We had that big 1982 to 2000 run up. That was one cycle, one up cycle. If you're looking at a yearly chart, you topped in 2000 and it took a long time to get back to the highs that we were at.
Right.
I mean, the NASDAQ topped in March of 2000 above 5,000. it was a very long, it was years and years, over a decade before we got to that 5,000 level again in the NASDAQ composite. Now, does that mean that you should have just sat that entire time out? Of course not. 2003 to 2007 was a wonderful time to be investing. There were so many growth names that were working so well. So yeah, you didn't want to sidestep that, but it was still part of that overall consolidation. And you go back the 70s, stagflation, and the 73, 74 bear market. That was one of those sideways times, and it was preceded by the post-World War II boom that happened in the 50s and all the infrastructure growth and the optimism of the 60s. And then before that, what did you have? Oh, you had some sideways action. It was the Depression. Before that, you had the Roaring 20s. That was your upcycle. So you look at that long-term chart and you have these upcycles and these sideways areas. So for anyone that's just starting out, it's kind of exciting. Understand that that doesn't mean you're not going to see 20% corrections. It's just that in your long-term plan, those will become very small over a 40-year time frame. Again, just look at 1987. Everyone thinks to Black Monday, and what a devastating day that was. Of course, you're down 20%, more than 20% in a single day. But when you step back and you look at a yearly chart and you look at that move from 1982 to 2000,
it's a nice one.
Yeah, it's a beautiful uptrend. 1987, it's hardly a blip.
You're talking about super cycles on the upside. Are there super cycles that are downsides?
Well, sure. You've got after the 1929 crash, you had a very severe, the most severe downtrend, and it took a very long time to recover from that. You had a few years where it was very hard to make any money. And then, of course, you had unemployment and that macro perspective. It was very interesting having Ben Bernanke as the Fed chairman, right at the time that he was because of his study of the Depression. Just understanding those macro elements and what not to do, what things to do, because he had devices to use that they didn't have back then. I don't envy the Fed their position of that balancing act. There's a certain element of that going on right now, trying to balance, all of those elements of the economy with this one tool of monetary policy. So, but yeah, you had that cycle, the 70s, as I mentioned, which was a pretty severe bear market. And then, of course, after 2000, now understand, I started investing in the late 90s. So when I started, I thought I was a genius.
You were, but everyone else was too.
Everyone else was too. And then 2000 hit, and, that was such a severe, correction, the worst that we had since the Great Depression. And I was told that was a once-in-a-lifetime event. And then 2008 rolls around, we have a financial crisis, and it felt like, wait a minute, is this another lifetime event? Because I only had one lifetime last time I checked. So it was.
It's like having a once-in-a-100-year flood, except you've had 3 of them. Let me ask you another thing, just getting back to the uncertainty. And a lot of the questions that we've been fielding recently have to do with this changing backdrop around interest rates. We've just gotten some data showing that inflation is creeping higher, and the Fed has already raised interest rates by 1/4 point twice this year. They're on pace to do it 4 times this year. How do you at Investors Business Daily, and how do you, Justin Nielsen, how do you factor in interest rates when you look at your overall investment portfolio? And I would ask you that as a long-term investor first.
I think that was one of the things that was throwing me so much, a few years ago, is when we were in this phase of quantitative easing and very low interest rates. I think in a lot of ways that was propping up the stock market considerably, because people were looking around and saying, okay, if I'm not putting my money in the stock market, where am I going to put it? Am I going to put it into a savings or CD where I'm going to get, a couple bucks for, the thousands and thousands of dollars I have? It almost forced money into riskier investments than the risk-free investment of treasuries that were paying nothing, or CDs or saving rates. So there were 2 things that were happening. First, it was shutting off the spigot of the quantitative easing, right? Let's stop buying the bonds. And then it was, let's stop, repurchasing bonds to take the place of the ones that are maturing. the question is, where do we go from here now that we've kind of had interest rates get up a little bit? And that's a good thing because, again, the Fed only has this one monetary policy thing that they can kind of adjust. And if any recession were to happen and our rates were already so low, they really didn't have anything to do. That their barrels were empty. They had already kind of shot everything they had. So, now that we've kind of gotten a little bit more of the Fed raising, and you mentioned the horizon looks like there's going to be more, but there's still that uncertainty of what happens a lot of times when the Fed starts raising rates is they overshoot, they overcorrect. And again, they have a hard job because the Fed is trying to do something where they're not going to see the effects for 6 months. And that's hard.
We'll get back to our interview with Justin Nielsen in just a minute. If you have a financial question, maybe it has to do with investing, maybe it has to do with something else, give us a holler. Our email address is askjill@jillonmoney.com, and we will be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You're back with Jill on Money. All right, now, with our guest today, Justin Nielsen, I decided to attack a question that a few of you, I wouldn't say the vast majority of you, but I would say a few of you have actually asked. It's essentially comparing how short-term government bond yields compare with long-term government bond yields, because there's something called a yield curve. And you're just starting to see some press talking about flattening yield curve, inverted yield curve. Things are going to be changing soon, and what you need to know as an investor. And this is all going to sound super wonky, and you're going to tune out. But I'm going to tell you something right now. Listen to this one segment with Justin Nielsen, our guest from Investors Business Daily, investors.com, and you are going to know everything you need to know about yield curves. Okay, here's more of our interview with Justin. Again, as a long-term investor, you are just sort of, I think, saying your advice is these things are happening. And even though it might freak you out in the moment to be like, interest rates are rising, I'm scared. Or one guy just wrote in and asked me about the inverted yield curve. And aren't we about to have a recession, and shouldn't I go to cash? A yield curve is basically plotting along a chart the yields, the interest you get paid, when you lend the government money on a short-term basis and medium-term and long-term, right? Normally, what does a yield curve look like, Justin?
Well, normally, on the short term, you would pay less yield because you don't have that much time in there. So there's supposedly a little bit more certainty. Now, long-term, you start going out 10 years or 30 years, you would expect, hey, I'm going to have to pay a little bit more yield. If I'm going to be locking in and committing to paying this yield for that long period of time, I'm going to have to, pay a little bit more because a lot can happen in 10 years, 30 years. So you would expect that the longer term bonds or whatever instrument that you're using, debt instrument you're using, would pay more yield the longer you go out.
So so your curve is sloping up to the right, correct?
Yeah. And again, that just makes common sense. If you had an option of getting the same yield at 2 years as you would at 30 years, well, why not take the 2 year and just, see what happens? You can always adjust afterwards. So yeah, that's the way it slopes up.
Okay, so right now, the Fed funds rate, which is the short term, is, where are we? At 1.75 to 2? Is that where we are?
That's about right.
That sounds right. And then the 10-year Treasury is at like 2.8-ish, 2.9.
And it was a big deal when that got above 3%, very briefly for a period of time, because that's when it was kind of like, okay, the short term is going up much faster than the 10-year was. So we haven't seen an inversion, but what's happening is that spread between the two it's getting very small. So we call that a flattening yield curve. And when you have a flattening yield curve, of course, the next question is, okay, does that mean we're going to go to an inverted yield curve?
Because, and now why is it so important? What is the important signal that an inverted yield curve would be flashing?
Most people look at the inverted yield curve as a very reliable signal that a recession is coming. Because basically, when you start saying, hey, you know what, I'm going to be paying more yield for the short term, and the long term, I'm not going to pay as much yield because I think things are going to go down, then that kind of means that you're expecting that the economy is going to go down. Because what happens a lot of times is, and it's a lot of this reaction, to reaction to reaction. When you've got your inflation that's finally getting up to the target rate that the Fed sets, then they want to make sure that the market doesn't overheat, that the economy doesn't overheat. And so here again, the way that they can do that is by raising interest rates, because all sorts of things follow along with that. What's weird in this case is you're usually applying a lot of this monetary policy when you're at kind of almost the bottom of recovery and you're trying to stimulate things. Well, we just had this stimulus in a tax reform package. So that's going to be putting some stimulus here. And the concern is, okay, if the Fed is, already feeling like, hey, we're getting close to our target inflation rate, and if we get up more, considerably more, and we've got the stimulus, then beyond 2 years, what are we going to need to do? What is that going to look like? What is that picture going to look like? And the fear is that the Fed is going to be needing to tighten more. And that means that the rates are going to go up, and that impacts all sorts of things downstream. Okay, so now all the corporations that have been used to this low rate environment, they have these borrowing costs, and those are going to go up. It's going to cost more to pay their debts. It's going to cost more for the government to pay their debts because we've got these deficits and, a huge increasing debt. It's going to cost more to service that debt. Households, if you've got credit card debt, if you've got any type of debt, it's going to cost more of your income to service that debt. And the question is, what does that money that is going towards debt servicing, what could it have gone to? It could have gone to growing the economy, consumer spending, all of those things. You take that element out, and now you're servicing debt, and your economy, what's going to grow that? So that's where, okay, long term, maybe these rates, maybe the economy isn't looking so hot, so the long-term rates aren't going up as much. And there's also, what do people do when they're scared? If trade wars, North Korea, the global marketplace, you start looking for safe havens. One of the safe havens is the risk-free return that you get from government bonds. And so you start purchasing more of those because you want to be safe, and that raises the bond price and lowers the yield. So it's that inverse relationship. As you buy more of something, in this case, the yield goes down. And so that's what could be also on the horizon for those long-term rates. And that's where people are starting to get concerned. Okay, if we get this inverted yield curve, and that's something that we see, often precedes a recession, well, what do we have on our horizon?
All right, we will get back to our interview with Justin Nielsen in just a moment. In the meantime, you may have something that you need to actually understand better. And if you need to do that, go to our website, JillOnMoney.com. You can read, listen, watch, sign up for our free weekly newsletter. You can also subscribe to our podcast. It's called Better Off. You can get it on our website, Apple, Stitcher, Radio.com, Google Play, just about anywhere you find your favorite podcasts. Okay, we will be back with more of our interview with Justin Nielsen in just a moment.
Have a finance question? There are many ways to reach the show. You can call anytime at 855-411-JILL, send an email to askjill@jillonmoney.com, or tweet a question on Twitter using the handle @JillOnMoney. Just use the hashtag AskJill.
You're back with Jill on Money. If you have a question, we really want to hear from you. It would be so great. Just give us a shout. And the shout means an email. Our email address is askjill@jillonmoney.com. Today we're talking a lot about investing. We get a ton of questions about investing, but this is not just an investing show. You know that. But I guess that given all of the news of the day, it's really hard not to try to figure out, like, big picture what's going on and what you should do about it, which is why we have our guest, Justin Nielsen, with us. Justin works over at Investors Business Daily, IBD to many people. The website is investors.com. He is the market research director there. He's also a member of the markets team. And, so far we've been talking a lot about, big picture stuff, what's going on. And I guess that the biggest question people are asking right now is around trade. So when you think about a lot of the policies that are being enacted, 50 billion, 200 billion, steel, aluminum, solar panels, washing machines, where does it all lead? How does it impact you? How does it impact the economy? How does it impact the stock market? All these things are big questions. Some of them are not knowable. Some of them we got some clues to. So let's go talk more with our guest, Justin Nielsen, right now. I want to finish with one question. Do you think that you are a better investor for having lived through a few bear markets?
Absolutely. I think, and unfortunately, as with most things, I think that when you're going through the hard time, it doesn't, you kind of look and say, oh, how could this be a good thing? But in retrospect, you realize, oh, yeah, that helped me. 2000, I actually got out very good in 2000. It was 2001 and 2002 where I was trying to go in too heavy too quickly. That's what really hurt me. And I'm so glad that I had that lesson when I had less money, because, if I had been a few decades into my investing career, making those mistakes would have really hurt. So I'm kind of glad to have some of those mistakes under my belt that I've made already with less money, so that as my account grows, I'm hopefully not going to make the same mistakes with a larger account. And, that's the same thing, getting back to that, I guess the overall theme that we've been talking about today is time frame. If you're starting out in your 20s and 30s, a lot of the stuff just doesn't matter for your long-term horizon. However, if you're getting closer to retirement, I think that's where you could really start worrying and, not sleeping at night, because you're worrying about, is my risk too much? And if, you see a major correction in the market, and you wait a year to go into more conservative investments, if you have everything kind of on the line in the stock market and you're supposed to retire next year, of course, you're not going to sleep very well.
No. And you know what I would say to that is that even those people, as much as you freak out because you're like, oh, I'm close to retirement, you aren't going to spend every dollar in your portfolio in the year that you retire. You're going to do something very nice for us. You're going to give us a gorgeous investors.com and an IBD chart that we can share with everyone listening to this. I want people to really take a good look at the long-term horizon here. It really does help you not freak out as much. And I think that you're absolutely right, Justin. Just like living through these things, it's not like it's fun, but you're like, oh, okay, well, I can get through this and I will get through this. And oh, by the way, my portfolio recovers, because that's what happens. So I don't have to make myself nuts. Well, thanks so much, Mr. Justin Nielsen, for coming on the program, his second performance. Mark, maybe we should put a link in the show notes to the first performance with Justin and his partner there at Investors Business Daily. Investors.com. That is the website, investors.com. Justin Nielsen, fantastic. Listen, before we go to the break, I realize that this has been poking around. It kind of dovetails nicely on the interview. I wrote an article for Tribune about trade deficits, just a plain old Q&A. And we got an email that was a follow-up question. How exactly does a trade deficit or a trade surplus affect the typical consumer and the typical retiree? That's what Anthony wants to know. And the answer is, not a lot. I mean, we carry a trade deficit because essentially we import more than we export. So, in 2017, the U.S. imported $2.9 trillion worth of goods and services. We exported $2.3 trillion. So we have a trade deficit in 2017, $566 billion. the thing is that when you have a deficit, it's not the worst thing in the world. It really, in general, doesn't have an impact on the economy. It doesn't really even have an impact on consumers because you get something for that. You get a good or a service. So I know that people get really crazy about a trade deficit. And Anthony, I think that the idea of like, well, what is it? How would it affect a typical consumer, typical retiree? I just don't know if we can make an across the board analysis that boils down in that way. Sometimes having a trade surplus is good for your domestic producer. So if you work at a domestic producer, that's good. Sometimes if you actually are a consumer, it keeps prices down, but it doesn't always work that way. I know it's that's a little nebulous of an answer, but there it is. Okay. Thanks again, Justin Nielsen from IBD. Investors.com is the website. And we got one more segment left. So stay tuned. This is Jill on Money. Hop onto the website, jillonmoney.com, and you will get all sorts of fun stuff. We'll be right back. You're back with Jill on Money. Before we finish out the show, let's squeeze in some emails. Linda wants to know about index funds. Do you usually purchase index funds on your own? Our financial advisor does not recommend them. Is that because there is no commission for that person? Yes, exactly. You know what, Linda? I want to know more about you. I want you to come on the air with us. I want to find out about this financial person. I love index funds. You can go out and buy your own very easily, I might add. I'm very, very I'm very wary of people who say like, oh, I don't like index funds. I'm not sure why. Okay, our next question comes from Peter about a 529 plan. So the question is, how can I convert a guaranteed to a variable for a 529 plan in Pennsylvania? I've been in it for 5 years, but I'm thinking my child will not go to Penn State. You know what? You're going to have to go to the plan itself. I don't know if you can do that. These are all very state-specific plans. And the guaranteed plan may be one of those where, you had to stay in for a certain period of time. But you go to MyPA 529. I think that's the one. I can't get into it because I don't have an account. But MyPA529.com. That's what I do. They definitely are. There are two different plans. One is a guaranteed savings plan that would require you to obviously go to a state school. Let's see. I'm just going to go through here very quickly. You can use your account to pay for most higher education expenses at many colleges, universities, and community colleges, as well as graduate schools. Oh, so you know what? You should look at this. You should see whether or not you may be able to use this guaranteed plan for a lot of different types of schools. So I would go check this out and see exactly what the plan is. There's an 800 number even, if you can imagine. Someone would actually answer the phone. That's what I would do. Go to the plan directly. Don't mess around. I think that'll do you just fine, Peter. A lot of these 529 plans, don't forget, they're starting to figure out what to do about the K through 12. Are they going to allow it, not allow it? All the plans are starting to roll some information out. So check with your state's plan. All right. That's it. That's the program. Thank you so much for listening. Don't forget to hop on to JillOnMoney.com. There you can read, listen, watch, and sign up for our free weekly newsletter. It's been a pleasure. We'll see you next week.